Good morning, everybody. Welcome back to Military Family Investing. We're back with a good one. Investing for Interest 111. Yes, 11 articles later. CD ladders versus Treasury ladders. Okay, so let's take a look. I'll explain what CD ladders and Treasury ladders are. Now, do you prefer saving or investing? All right, most people are not investors. All right, it takes a lot of emotion. Saving is very analytical. All right, so if you're a big saver, this is good. This will be a good article for you. Okay, so the Federal Reserve has said that interest rates will remain higher for longer, meaning we're going to be probably above 4 or 5% interest rates for a while. So let's go ahead and get our yields right now. Now, go ahead and download the book. I like these little ladder people fighting. All right, so download the book for free. Now, there are ways to save: high yield savings accounts, certificates of deposit, Series I bonds, and U.S. Treasuries. All right, there are the rest of the 10 articles. Now, what is a savings ladder? Okay, for CDs, for the most part, they're 1, 2, 3, 4, 5 year CDs. All right. And so you go to your bank, you deposit X amount of dollars, and then you lock your money up and you get interest on it, kind of like staking in cryptocurrency. Now, for treasuries, they go anywhere from 1 month to 30 years. All right. You can find an increment for you. Now, what is a ladder? So, ladder is buying different maturities at different times to protect yourself from duration risk, meaning if you buy a 4% 30-year bond, there's a chance that over those years, maybe interest rates go to 8%, okay? Or maybe they fall down to 2%. So the longer that you have your bonds or your CDs, the more risk you incur, right, against current rates. Now, I'm a buy and hold. So when I buy something, if it's a good deal, I lock it in and I keep it, all right? I don't plan on selling. However, it's good to have 1, 2, 3, 4, 5, 30 years, whatever. They all rotate off at different times. Say I have a 20-year, a 10-year, 20-year, 30-year. In 10 years, interest rates look bad, horrible. So I go, maybe I buy some preferred shares. I lock those up. Or I buy dividend stocks, whatever else is the case. Okay, so that's why you want these maturing at different times. Now, for instance, I bought 30-year bonds during April 2020. The yield was 1.3%. All right, and I locked in 1.3% for 30 years. Look at current rates are 4%. All right. So if those were a 2-year bond, then they will mature. I lose no money, and I would put it in at this new rate. All right. So that's the power of CD ladders and Treasury ladders. Now, so let's look at some of the differences. Duration. We already talked about that. You get more options with Treasuries. Okay. Now, for CDs, let's talk about minimum deposits. The minimum deposit for a Treasury, whether it be a bill, a note, or a bond, and you can see what they all mean right here, is $100. So it's awesome, right? So if you're just learning and you have $200-300 to invest per month, perfect. All right. CDs, not so much. All right. For the most part, what I've seen is about $2,500 if you want the highest rate and you're looking at 3 to 5 years. Okay. So if you don't have a lot of money sitting around, it's very hard to make a CD ladder. Okay. So that's something to think about. So here are some examples from Penn Air, Federal Credit Union. So high net worth individuals who have 100,000 laying in the bank, 200,000 laying in the bank, it's easy for them to create CD ladders because they can just pull 5,000 here, 5,000 there. If you don't have that much money, it's not as easy. Okay. Now, CDs. Let's talk about capital gains and losses. CDs aren't traded on the stock market. All right. Neither are bonds, but bonds do trade on the bond market, meaning that there's a chance if you need your money quickly and you can't wait till maturity, you can get burned with bonds. Okay. So my 1.3 yielding bonds aren't worth anything against a 4% bond now. All right. So in order for somebody to buy my 1% bond, the price, okay, the par value will have to decrease. All right. So bonds start at par 100. Okay. So when I bought my bond at 1.3%, it was par 100. So when I sell it, it would have to lower down to maybe par 70. So $70 on a dollar for somebody to take it. So I need to increase the yield by lowering the price. Okay. Inverse relationships. Kind of like mortgage rates. Okay. So mortgage yields, same way. Mortgage rates have risen. So house prices have to go down so that you can afford the payments. So homeowners, home buyers can afford the payments. Same thing. Inverse relationship, prices and yields. Okay, that's confusing, but just keep beating that into your brain over time. All right, it's going to take a while, but again, uh, just think about a sale at a like a Walmart or something. If when things are on sale, you buy more. Okay. Now, ease of purchase. Treasury bonds allow you to make automatic purchases. So you can set, hey, $200 per month. Now, since treasuries trade on the market, you're not guaranteed. You buy a $200 treasury bond, but it might cost you $210 or it might cost you $190. So it's always good to overshoot. Okay. I've been in a position where, I had something scheduled during March of 2020 and everything spiked, right? Because of the pandemic. And the bonds were, instead of paying par 100, it was like par 120, something ridiculous. I couldn't even make the purchase because it was like way too much because everybody was flocking to bonds. Okay, so just be careful. Now, CDs are much harder to buy. Not harder to buy, but it's more transactional per thing. So you can't just set up hey, buy this CD, buy this CD. Each CD is its own instrument, and it's a lot. It's more planned out. Okay, so early withdrawal penalties. For the most part, you just hold your securities, your bonds for 45 days. Again, you're going to trade them when you sell them. You're going on the open market. So if you buy something for $100, you buy $100 bond. You turn around and sell it 2 months later. It might have to sell for $99 or it might sell for $101 based on interest rates. So the bonds market fluctuates every day. Okay, so you can go to a website, type in 30-year current bonds or current bond yields, and every day the bonds are worth something different. Usually, based on the stock market, based on interest rates, based on fear, based on the job reports, housing reports. So the bond market is way more sensitive and less emotional than the stock market. All right, so enough there. Anyway, and then for CDs, you do incur minor penalties for withdrawing your money early, but it's nothing too crazy. Now, a big part is taxes. Okay, I just wrote about this in Treasury bonds versus municipal bonds. Treasury bonds are exempt from state tax. So you live in New York, you live in California, somewhere with a high state tax, that might be a deciding factor. All right, remember, interest is taxed at your income tax level. So if you're in the 30% bracket, 39% bracket, that's what your interest is taxed at. Okay, so you're not making a lot of interest yield, but your money's safe. Keep in mind, your money's safe. All right, so you say you earn $40 on your CD. Right off the rip, the federal government's going to take, based on your thing, say you're 30%. Right off the rip, the government's going to take probably what, $12, right? So, and if your state takes another 5 or 6, that's a huge deal, right? So, beware. All right, so beware. I live in a no state tax area, so I can do either one. So I'm good. I live in Florida. Now, here are my personal thoughts. Me, I'm not a big ladder person. I just want the longest yield at the best rate. So I'm just a hardcore 30-year guy. I don't plan on selling my bonds. I don't sell anything. Now, if for some reason I get like a 5% bond and I buy 5% bonds for 2 years and the Federal Reserve lowers rates to 0% and my bonds are worth par 130, 140, yeah, I'll probably sell a couple, right? That's awesome, right? And then I wouldn't buy back bonds. I will probably buy treasury or preferred shares or something where I can get yield. But yeah, but other than that, I'm only would sell bonds when it benefits me. All right, I'm not going to put myself in a position to where I need my bonds for income. All right, that's or for to sell my bonds for income. All right, that's why you have emergency funds. Okay, now either way, you're doing more than the average person. All right, the average American. So it's good that you're focused on CDs, treasury bonds. All right, it's boring. You don't get a lot of money from interest, but if you cannot look at your principal going down like in the stock market, stay with this. All right. Most people can't look at the red in their stock market and have some kind of composure. So stay with saving then. Build all your savings rates and all your different stuff because if you can't handle it, stay out of it. All right. So CDs, treasuries. I'm a big fan of treasuries. All right. They're good wherever you go. You're not tied to a bank. You're directly with the federal government. You don't pay state tax. You have more options. They fluctuate. You can get capital gains on them. Um, but CDs are good because it's closer to home, right? It's safer. It's FDIC insured, so there are also some benefits too as well. So whatever you decide, man, like have a good time, like have fun, take it seriously, take it like a job. Download the book, read some more about it. Start piecing out. The different. Go to the Treasury Direct website, look at the current rates. Some guy speeding on base. Look at the CD rates at your um, bank and see what's going on. So with that, I am off for today. I will talk to you guys later. Bye.